Ha, ha, ha.
Oh,
We're
wait.
broadcasting now.
Yes, we are. Thanks, Sam.
Oh, anytime.
Okay, let's
Anytime
turn
we
off
can
our
hit the
video,
broadcast
folks.
button, let me know.
Okay, have a great class.
Thank you. Thank you. Thank you. So Donna, are you still there?
Yes, I am.
Because I can't see you, so.
I'm the CE Shop logo.
Oh, well, I don't see that either, but it's okay.
Oh, okay.
As long as I know you're there.
There you are. Yeah. You may feel lonely, but we're all still here.
You tell me when I should start saying something or doing something.
We will. Amy will start
Okay.
here in a minute.
Okay. Donna, would you like me to start right now?
Yes, please.
All right, I will. So everybody, thanks for joining us today. We'll be getting started in just a few moments. If you can, confirm that you hear us by typing what state you're coming from into the Q&A box. Then we'll get started momentarily. Just want to know where you're from. The Q&A box is also where you'll enter your questions, but oh good, we're getting some answers. Great. It looks like we have students from several states. We're going to go ahead and get started. So everybody, welcome. Thank you for joining us for today's webinar. A little housekeeping before we get started. We'll be running a live Q&A at the end of the webinar. If you have any questions during the presentation, please type them into the Q&A in your Zoom control panel, just where you're typing your states. And if you miss anything, don't worry, we'll send you a link to the recording when it's available. My name is Amy Chamberlain. I'm an instructional designer at the CE Shop, the leading provider of online real estate education. Today, we are covering another national review topic, financing. Our presenter today is Dr. Sam Martin from North Carolina. Sam comes to us with a tremendous amount of experience in real estate education. He was recognized by the Association of Illinois Real Estate Educators in 2014. Sam is the owner of samthetutor.com. Now, let's turn it over to Sam to get us started.
Okie dokie, very good. Well, welcome everybody. I am Dr. Sam. I am a broker and an appraiser, and I've been teaching since forever. And I have all kinds of letters after my name, so I'm all things to all people. So if you have any questions, don't hesitate to send them in on the Q&A. And we're going to start with a brief poll. We'll have a little overview of financing. We'll have a little question and answer period, and there are additional resources at the end. And then will come the big conclusion. So I'm thinking we started a little bit early, which is okay, we're fine. But we have a little bit more time for ourselves. So see, it all works out in the end. We're going to be great. And here is a little poll. How far along are you in the course? I'll give you a couple of minutes to answer this. And in just a few seconds, I'm going to share this with everyone. It's interesting, very interesting. So most of you are pretty much concluded. I'll just end that and share that. So now we can all see that some of you have just started. You're kind of all over the board, and a bunch of you are almost done. So congratulations for that. And I would think that wherever you are in the process, this is still going to be beneficial for you. If you haven't had finance yet, then consider this to be a quick and dirty introduction to finance. If you're almost finished and you've already had finance, then this should be a really handy review for everyone. So very good. Good job. And I just wanted to introduce the polling feature to you so that way we can get accustomed to it. And it's a relatively quick process, so you don't have to dwell on it. It's better actually if you just answer it spontaneously. Whenever we have a poll question, I really want you to come from the gut, unless it's a math question. Then I'll give you an extra 10 seconds to finish it. Anyway, let's move forward here. On most state exams, the exam that you have to take to become a broker or a salesperson, wherever you are, they give them different names sometimes. But I've noticed that by and large, contracts are usually the 900-pound gorilla of the exams. Contracts, and then agency, and real estate practice. Real estate practice might be state specific for your state, but overall, on the national, these two are 30%, almost a third of all your questions. And on your state specific test, if you have a state specific test, this could be another 20 to 30% of that test. So the way I would handle this if I were you, and I've been dealing with these types of exams for years, the way I would do it, two things. I would see how many questions are in this. Then I would say, is this a weak spot of mine or not? I would do that for every single one of these items. And let's say, for example, property management and leasing, you're feeling kind of queasy about. You don't know much about it yet, but it's not going to have a whole lot of questions, is it? So I would recommend dwelling mostly on the big ones, get those all sorted out, and work my way down, I think. So let's see. What I think we will do now, let's move forward, and don't hesitate to write questions down. Always write them down or submit them in the Q&A if you need to, and we'll warehouse them for you. So if a question pops up early, great. Write it down, submit it. We'll deal with it towards the end when we have spare time. Now, here's a quick little review. Who is the mortgagor? Is it the lender or is it the borrower? Who do we think is that mortgagor? And this is kind of a confusing concept. People are always getting these things mixed up. The mortgagor is the borrower. It doesn't really rhyme per se. It's not great, but I always remember mortgagor, borrower. Lender is the mortgagee. They're receiving the pledge, they're receiving the mortgage. And if you mess up who is who, really incredibly bad things happen to you on questions on tests. So if you mix up who's the mortgagor, who's the mortgagee, you get questions backwards. They'll give you a whole big problem using the words mortgagor and mortgagee in the problem. And if you get them backwards, then instead of answering A, you're answering D instead. So we don't want that to happen. And here is a beautiful flow chart. I like flow charts. It takes some strong glasses and a magnifying lens maybe to look through this. But I think we should start with us, because we, the consumers, are the ones who are driving this whole thing. Without us, the rest of this pyramid just falls apart. So we go into a lender and say, we want to borrow some money. We want a loan. We promise we will repay you. It's not that they don't trust you. It's just that they don't trust you. So they're going to want you to promise them that you'll pay the money, but they also want to pledge. So if you don't pay the money, they'll take your house. Once you straighten that out, they give you the money. Now, who gives you the money is a lender, a member of the primary mortgage market. But the lender can either keep your loan intact in-house, in which case they're a portfolio lender, or they can sell your mortgage. And you gave them permission to sell it. When you signed the paperwork, you said it was okay. So they're assigning their interest over to the secondary mortgage market, Fannie, Freddie, Ginnie, Farmer Mac, and other players. They buy mortgages. They make a market for mortgages. And then they buy the mortgage from the lender and give the lender money. What does the lender do with this money? They lend it to more borrowers. And the cycle keeps going and going and going and going, like a big figure 8 here. The secondary mortgage market, without Fannie, Freddie, and Ginnie, none of us would be in this webinar now. They drive the residential real estate market and stabilize the entire economy. They keep credit flowing, cost of borrowing is reduced, and the ease of borrowing, like underwriting, is enhanced. Then Fannie, Freddie, and Ginnie, they can sell components of the mortgages to other major league investors, and they buy these components and give Fannie, Freddie, and Ginnie some money, which they then use to buy more mortgages. The lenders make more money, and they use the money to lend to you. In a nutshell, we just covered basically macro and micro economics all in about 5 minutes. So, you know, it's you just officially got an economics degree. So enjoy. Anyway, it's time for a think time review. The borrower was unable to continue paying the mortgage, ruh-roh, after 6 missed payments. Holy guacamole. The lender notified the borrower of an imminent foreclosure. In this situation, the foreclosure proceedings are more difficult for the lender because the borrower holds title to the land. What kind of mortgage theory applies here? So is it intermediate theory, title theory, lien theory, or deed of trust theory? Everybody answer. It's no fun if you just sit there and you don't do anything. Hit some random keys on your laptop. Show us that you're there. Get up to about 40, 45, and then I'm pulling the trigger on this thing. Get your vote in. I'm from Chicago. Vote early and vote often. That's our motto. And that's about it. Let's share this. And most of you thought this was title theory. Good guess. Some of you thought lien theory. I'm a big fan of that. We'll see why in a minute. And then a few of us thought it was deed of trust theory. But there is no deed of trust theory state. So that is not working well. So let's stop the sharing, and there you go. There are the results. And we are going to take a look at the next screen to see that it's really a lien theory state. The only recourse the lender has in this type of state is to put a lien on the collateral. In other words, you default on the note, they have to foreclose on the lien. In a title theory state, right here, that would be like the state where I'm living in now, which is North Carolina. We use deeds of trust. So a title theory state, the trustor is the borrower, and they put their trust, they put their title into a trust. They give their title to a trustee, a trusted party. The beneficiary is the lender. Remember what I just said. The beneficiary is the lender. Not that I'm giving you a clue about anything coming up soon, but oh, look at this. Harriet is buying a home in a title theory state. Her lender indicates they will be using a deed of trust. If you get this wrong, I just don't know what to do. The lender will be the trustor, trustee, mortgagee, or beneficiary. I am shocked at this result. Let's see. How many people are going to get it right? Up, you stopped responding, so pow. Amazingly, all of you got it right. If only they did this right before the state exam, where they would just give you things like this. Wasn't that fun? I like that. I like that question. And don't forget, ask questions if you want to ask questions. So beneficiary is the right answer. Hooray! Now, methods of financing. You have conventional loans, and then you've got non-conventional loans. That's pretty easy. Either conventional or not conventional. Conventional is the standard. It's what most lenders lend. It's non-governmental. And it's got traditional loan-to-value ratios like 80%, relatively conservative underwriting, and non-conventional would be FHA or VA. FHA insures mortgages. They do not lend money. FHA is not in the primary mortgage market. At VA, if you're a veteran, a qualified veteran, or the surviving spouse of a qualified veteran, then you can initiate an application for a VA guaranteed loan. So two things, FHA and VA are not lenders. FHA insures, VA guarantees. And those, for some odd reason, are testable items. Also, a real quick note about FHA, the most common FHA mortgage is the 203B. And I've had feedback recently that that is even asked on some state exams. So it'll ask you, of the following, which is the most common? And you're looking for 203B. I don't know why. I don't know why they would care if we know that, but I guess they do. And seller financing. When you become a broker, always ask sellers if they would entertain providing some or all of the financing. It's nice, especially for seniors, if they want to earn a little extra income. The seller essentially turns into the lender. They're lending the equity in their home. A purchase money mortgage, the seller gives title to the borrower, to the buyer. In a land contract, the seller retains title. The buyer is still considered the owner, but the seller retains the title. There's more security in it for the seller then. Uh-oh, it's think time again. I smell a question coming up. Here it is. A buyer is evaluating loan options and is considering an FHA loan because it requires no down payment, requires the seller to cover all closing costs, requires a low down payment, or insures the mortgagor against default of the mortgage. And there are a couple of test taking tips I want to go over once we see the answer here. So let's see, let's get us up into the 30s. We can do it. Rah, rah, sis, boom, bah. Answer that question. Go us. Ooh, this is the highest number I think I've seen all afternoon. Very nice. I am impressed. And notice, requires a low down payment. That's where we want to be. Requires a low down payment. Does not insure the mortgagor. Who's the mortgagor? Who is the mortgagor? Isn't that the borrower? Do you think they're insuring the mortgagor against default? They're really providing insurance for the lender, the mortgagee. So let's see, we'll get rid of you. Very good. So low down payment. Two issues here. Requires the seller to cover all closing costs. Anytime I see the word all, always, never, any absolutes, I'm very, very uncomfortable with that choice. It's too much of a too much of an absolute for me. Also insures the mortgagor, we covered that already, the wrong party. They're covering the borrower here. So we don't like that. And very good though. Everyone doing really well so far. A borrower seeking a loan is required to provide a certificate of eligibility. Which type of loan is the buyer trying to obtain? So is it FHA insured, VA guaranteed, conventional loan, or seller finance loan? And you should know this. You should know this so well. As soon as you see certificate of eligibility, the answer should scream at you off of the page. You shouldn't even have to look at all the choices, although you should look at all the choices, but it should just jump out at you off of the page. That's how well you're supposed to know these things. So let's see. And you are correct, VA guaranteed loan. Good job, good job. Most everybody doing really well here. Very nice, very nice. And let's get rid of that. And there we are, VA guaranteed loan. We have another question coming up. A contract in which the seller finances the buyer's purchase by retaining the deed to the property while the buyer makes payments toward the purchase price is known as a people are a little slower answering this one. I smell a weak area for some. Very good. You have recovered nicely. Good job. So let's see. It is a land installment contract. And perhaps a little bit better way of phrasing this would be a contract in which the seller finances the buyer's purchase by retaining the title to the property. But it wouldn't matter for you taking a test because you have to be able to think on your feet. You know what they mean, right? You can't ask the proctor at the exam center, oh, pardon me, the grammar here doesn't look good. What's the proctor going to say? They can't correct anything. So anyway, a purchase money mortgage, the seller gives title to the buyer. Land installment contract, the seller keeps the title. And just remember, not part of this question, but really important to remember, with a land installment contract, if the buyer defaults, they lose everything they paid. It's a complete and total default. So they lose all the money they ever paid in on that installment contract. So very good though, everybody doing really well. Very good. Types of loans. There are fully amortized loans, partially amortized loans, adjustable rate loans, and fixed rate loans. And a lot of overlap in these things. A fully amortized loan, every payment is principal and interest, and all the payments are roughly about the same. From beginning to end, the final payment is very roughly the same as the first payment. That's an amortized loan. And over the life of the loan, you pay off the principal, little dribs and drabs, every single payment. Each payment a little bit more towards principal and a little bit less towards the interest to the lender. Partially amortized, they schedule you for this much time to pay off the loan, but they only give you this much time to make payments. That means that somewhere around year 5, 10, or 15, the final payment is being made. That's called the balloon. It's the final principal payment to pay off the loan. At that time, the balance is still usually pretty high, so you either won the lottery, or worked 3 jobs, or you refinance, or you sell the house to cash out that balloon. If you can't pay the balloon, they call it a balloon because if you don't pay the balloon pops. So let's not have that happening. A partially amortized loan, we talked about, adjustable rate and fixed rate. Fixed rate, the interest rate is fixed. I know, Captain Obvious here. But an adjustable rate is tied into an index. The index goes up, interest rate goes up. Index goes down, interest rate goes up. No, it just seems that way. If the index goes down, interest rate should go down too. It should. Can you see how an amortized loan could be either an ARM or fixed rate? And a partially amortized loan could either be an ARM or a fixed rate. So there is quite a bit of overlap going on here. And now, think time. Oh my God, they have another question for us? Oh my God. A loan with a rate that fluctuates based on the economic index to which it is associated is known as a graduated payment, amortized loan, ARM, or index loan. Gee, which of these answers has an interest rate that adjusts? Very good, very good, very good. Most of us got that, right? An adjustable rate loan has an interest rate that adjusts. Some of you bit on this, the index loan, because it says index. Ain't no such a thing. There's an index lease, has nothing to do with this. So an index loan is tempting. It's a distractor, as we say in the education business. It's meant to suck you in and make you answer something wrong. Don't fall for it. The real answer is adjustable rate loan. And yet again, you all did great. There we go, adjustable rate loan. A loan with a fixed P&I payment, in which initially most of the payment goes towards interest, with ever increasing amounts going towards principal until the loan is paid off. Which of the following terms identifies this loan? Is it straight line, growing equity, amortized, or balloon? Very good, very good. And I just want to tell you Our slides are switched, so you got the right answer slide first. The first slide is actually second. So congratulations, you were given an answer. This is like the best. So, but you all did really well, all getting the right answer. So a loan, you know what it means to amortize something? It's from the Latin and it means to kill slowly over time. So much mortality in real estate. Who knew? So an amortized loan, you're slowly paying the balance down, balance down, balance down as time goes by. So very good. Good work, everybody. And there's the right answer. There's the blank one. And another question. These questions must be important. There seem to be a lot of them. When a commercial property is difficult to finance, an investor will sometimes buy the property for cash and then lease it back to the seller. This provides income for the investor and allows the building owner to remain in the building, conducting business as usual, while freeing up capital that was stuck in the real estate. So I'll give you a couple of seconds and maybe you can try to remember what type of problem this is, what type of mortgage this might be, and how juicy would this be as a real estate broker connecting the seller, the investor, and then you'll get a rental commission, maybe a sales commission on the front, and maybe a sales commission on the back. Sounds like money to me. You know, when I look at this and I say, there's a seller and they're selling, and then it's leased back to the seller, I'm pretty sure that's going to be called a sale leaseback. So the seller, in order to get all their money out of the investment, they sell the property instead of refinancing. But it's a done deal with the investor. The investor knows the seller is going to sign a lease for that investment, which makes it real secure for the investor, the buyer, doesn't it? They have a built-in tenant. And I've seen situations like this where the property sold for $5 million and the seller who turned into the tenant rented it back for $100,000 a month. Who here would like to make $100,000 a month in rent for 10 years, and then the seller bought it back? Life is good. Hey, it's a chart full of numbers. You gotta love a chart full of numbers. That's what I say. Well, I think we should do just a teeny tiny bit of math here. Some of you will take a state exam where they give you a chart similar to this. They might have the chart up on a cubicle wall for you to look at, but here's how this works. You are told the amount of the mortgage. You are. Divide that by 1,000. So if it's 100,000 and you divide it by 1,000, you have 100 units in that sales price or in that value, whatever it is. So if you have 100 units, keep that in mind. That's the first number I need. We'll pretend, I'm just making these up, 30-year loan, you go down this column, 5% interest, you go across this row, and then you're at 5.36822. That is a mortgage factor. Take that mortgage factor times the number of units, which we said was 100. You're going to get $536.82 a month. That is the principal and interest for the mortgage I just told you about. And you'll be expected on some of your tests to do one or two of these, at least one or two of these. Easy peasy, easy peasy. And in real life, one day, you'll be out there working with investors and you will use something like this, an HP12C. So you can do this with a calculator and look like a professional. You're not going to carry a book of charts around with you. But on your test, probably you'll wind up with at least one chart like this. So I hope that everything is okay so far. More basic concepts. Hot diggity dog. We've got lots of basic concepts here. So points, LTV, PMI, interest, PITI, and loan origination fees. Let's talk about each one of these. 1 point is 1% of the mortgage amount, not the price, the mortgage amount. It's prepaid interest. LTV is loan to value ratio. It's the percentage that you're allowed to borrow, percentage of sales price. So if I said the LTV was 80%, that means if the sales price is $100,000, you're allowed to borrow up to $80,000. PMI is private mortgage insurance. That's a private insurance policy the borrower pays for. The lender for a conventional loan is willing to lend up to 80% of the price. If the borrower needs more, then let's say they want to borrow up to 90% LTV, that extra 10% is risky. And the borrower will make, the lender will make the borrower get private mortgage insurance to cover that excess, to cover the riskiest part of the loan. If there's a default, the PMI company, which is an insurance company, will pay off the lender for that gap in between 80 and 90% LTV. Interest, well, the principal is the amount you borrowed. Interest is the juice money that you pay for the privilege of borrowing their money. It's income to the lender. PITI is the monthly principal, interest, taxes, and insurance, PITI. So it's monthly P&I, that's the mortgage payment, the annual real estate tax bill divided by 12, the annual hazard insurance premium payment divided by 12. That's what PITI is. And a loan origination fee differs from points. Points are prepaid interest, but loan origination fee is administrative. It is, oh, we had to make copies, so we're charging you $500. It's one of those types of fees. So, we have another question coming up, and it's math. Everybody's favorite. It's a math question. A borrower obtained a 30-year loan, 5% interest, a $300,000 principal balance. How much interest will be paid in the first month? Is it going to be $1,250 in the first month, $15,000, $1,500, or $1,750? What do you think? What do you think? People are answering 50-50 so far, pretty much between answers. Let's see. People changing their minds and switching over. It's a fluid process. And if you think you don't like math, you like math. Math likes you. It's all just math. What could go wrong? It's just math. Ooh, I know. Let's figure out how well we did. Most of us said 1250, which is right. I'll show you the answer in just a minute. Interesting. And the other answers, I'll go over each one in turn in just a moment. But overall, doing very well. I was really impressed by this. So now, answer is 1250 for the first month. Here's how we figured that out. 300,000 times 5%. That's 5% for the projected for the whole year. That's 15,000. If you thought that you were finished because you saw this here, then here's the logic. This is a $300,000 loan, and you've got 30 years to pay it off, and 1 month's payment is $15,000, and that's just too much. I would eliminate that right off the very top. So here's the rest of the problem. We got the 15,000 projected interest for the first year, divided by 12, because there are 12 months in a year, and that gives us the 1250 right there. Does that make sense? Is everybody okay? You know, I worry about all of you. You're all my little ducklings now. How's everybody doing? And another math question. You can't get enough math. That's what I say. The lender will charge the borrower 2 discount points, a $500 loan origination fee. Sales price is $250, 80% LTV. What is the total amount of lender charges? So is that $4,000, $4,500, $500, or $200,000? This response a little bit slower because there are more moving parts to this question. The solution, you have to do a little bit more to it. I'll wait another few seconds. All right, let's share. And the answer is 4,500. Most of you got it right. Congratulations. And let me clear this out of the way. 250,000 times an LTV of 80% means the mortgage is 200,000. That has to be your first step. You need to know the mortgage amount. Times 2 points, 2%. Each point is 1% of the mortgage amount. That gives us 4,000. That would have been this answer, but don't forget, they wanted to know the total lender charges, including the $500 loan origination fee. That's 4,500. So there we go, 4,500. PMI, we already talked about, private mortgage insurance. Mortgage insurance premium is similar, but different. A MIP is a charge that FHA makes for an FHA loan, FHA insured loan. And instead of calling it private mortgage insurance, they call it a MIP. It's an upfront fee and a monthly fee that gets charged to the borrower for the privilege of getting an FHA insured loan. TILA RESPA Integrated Disclosures, my favorite acronym, TRID. It is overseen by the Consumer Financial Protection Bureau, the CFPB, and two provisions that TRID makes. It provides for a loan estimate, an LE. That is a document given to the borrower by the lender within 3 days of application. 3 days of application. The closing disclosure is another document provided by the lender that's given to the borrower within 3 days of closing. So the borrower has a chance to review the terms. The LE and the CD are kind of supposed to match together a little bit here. Some items can't change at all. There's no grace. Other items that the lender has no control over, like the premium for the title insurance, there is no real regulation about how much they can change. But there are strict terms about interest rates, for example, that the lender has direct control over. So LECD, that's under the RESPA side of things. The TILA part is called the Truth in Lending Act. It's kind of like fair housing, except it's for lending. And we'll see in just a minute that TILA has provisions about advertising, fair advertising. And TILA often is called Regulation Z, Reg Z. So the whole point of TRID is to make all of this legislation, which has been around for years, to make it easier to understand, more transparent for borrowers, and to help reduce closing costs and ultimately to reduce confusion, I think. Uh-oh, it's think time. Oh, more questions. They're giving us more questions. Which of the following statements is true regarding an ad that contains a triggering detail of a loan? All items must be disclosed. And what did I say about that? Triggering details in an ad are always illegal. Non-triggering phrases must disclose all loan terms. Disclosure is not required of lenders at all. You're answering much faster now that it's not math. I wonder why that is. I don't know. Very good, very good. And let's pull the plug. Oh, can I get one more? Thank you. I was trying to get to 40. I was like, oh, please. So all items must be disclosed. All items, anytime that you have a trigger term, a trigger detail, all the items of that loan must be disclosed. It's often buried in fine print in an ad, but still it's all got to be there. So very good, very, very good. And let's go here. So all items must be disclosed. And another similar type of question. Which of the following statements requires full disclosure? Put this in my best advertising voice. Buy a new home for $1,000 per month. How'd you like that? I practiced that. Low monthly payments. Low down payment. VA loans available. I could be in voiceover. We ought to have webinars like every week, at least every week. This is fun. I like this. Oh, more of you can answer than that. Step up the pace. Let's go. Answer questions. Okay, I'll let you get by with that, I guess. And let's share the results. And anytime I see a specific number, I am very leery that that's a trigger term. So $1,000 a month, interest rates 5%. The down payment is $750, something of that nature. That makes me suspicious that that's a trigger term. In which case, somewhere they're going to say, for example, if you borrowed $100,000 for 30 years at 5%, your monthly payment will be $1,000 a month, blah, 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 blah. So low monthly payment, low down payment, VA loans available. Well, they could just as easily say farm loans and commercial loans and FHA loans are available. None of that would be a trigger term. And let's see now. Let's get rid of that. So buy a new home for $1,000. That is the item that requires a, it's a trigger term that requires full disclosure. And if you didn't have enough laws already, here are more laws. So there's RESPA, the Real Estate Settlement Procedures Act, which has been around since forever. And it regulates referrals between settlement service providers, like between surveyors, home inspectors, brokers, attorneys, closing attorneys, and then rebates. But instead of rebates, what you'll often see would be something like kickbacks. And RESPA always says kickbacks are prohibited. So if you ever see a test question that says, are you allowed to accept kickbacks? That doesn't sound good at all. I don't think I better be accepting kickbacks. I mean, I'm from Chicago, and even I know I'm not supposed to accept kickbacks. So, I mean, vote early, vote often, and no kickbacks. So, Equal Credit Opportunity Act has protected classes, just like fair housing has protected classes. So your job, at least for the ECOA, is to try to remember these protected classes. They might ask you, which protected class is in Equal Credit Opportunity Act, but is not in fair housing? They could ask you, questions like that. So you have to know the difference between those two. And as I recall, one of those would be dependence on, what is it now? Income source. In other words, if your income source happens to be government assistance of some sort, the lender can't use that against you. That is not in fair housing anywhere. So that's one example of the difference between ECOA and fair housing. And, oh, this means we're practically near the end. Can I have more slides, please? I've run out of slides. I was just on a roll. I'm good for another hour here, and you've run out of slides for me. Oh, well, I guess I have to stop soon. So, there are some experimental questions in these tests, and they don't count. The testing agency is testing the questions on you. You are the guinea pig, whether you like it or not. Normally, you don't know, you're not supposed to know which is which. You're not. So you have to answer all of them, the best of your ability. But we've been told there might be a little way to tell the difference. All these questions are timed. There's a little timer going off. When you hit an experimental question, sometimes the timer stops. You see, they don't want your score to be hurt if you answer the experimental question wrong. They don't want you to burn up valuable test time trying to answer an experimental question. So they stopped the timer. Personally, it makes no difference to me whatsoever. If I'm taking a state exam, I'm already nervous enough. I'm not going to watch a timer to see if it's still ticking on any question I'm answering. I'm going to answer them all, and I'm going to answer them all really well to the best of my ability. So, on another thing, and then we'll pretty much be done. Time management. Absolutely, time management is critical for you. So check your candidate handbook or guide, see how many questions you're answering, see how much time they're giving you. Take the number of minutes divided by the number of questions and see how many minutes per question they're giving you. Usually it's a number around two-ish, 1.5 to 2 minutes. Plenty of time. I promise you it's plenty of time. But if I have finished 10 questions, I look at the clock on my computer and 30 minutes have passed, that's 3 minutes per question. I'm kind of slow, right? Maybe I should pick up the pace or I'll run out of time. But if I look after 10 minutes and I see 10 minutes has passed, gold, this is not bad. I'm making good progress. I hope I'm answering them correctly, but at least I'm making good progress in terms of time. So I think and what the passing score is, check your detailed content outline in that guide to see what subjects are covered and how many questions in each subject. And basically, and mark things for review. Don't skip anything. Put an answer down for everything. And then mark it for review if you're not sure. And go back. If you have time, go back. Don't change the answer. Don't change the answer unless you get an aha moment that says, oh, this is wrong. I know this is wrong. And I know what's right. And then you change it. Aside from that, don't change those answers. And somebody before, I think I saw a chat fly by, defeasance and acceleration. I can do that in a minute or two. Defease, the stem defease comes from the Latin that means defeat. If you see defeasance, it means you have the right to defeat your note. When you pay off your mortgage, isn't the lender supposed to release you? Right? You're supposed to say, okay, you're gone. You paid it off. Goodbye. Why? Why should they? Why should they do that? You think they want to do that? No. They'll do it because there's a defeasance clause that says they have to release you because you defeated the note. That's defeasance. Acceleration means you violated some part of the note, and now they're asking for all the mortgage balance due and payable in full right now. They have accelerated your note. You had 30 years. Now you have no time. They want a check from you now. That acceleration clause, when they activate it, that's generally the first step in the foreclosure. That's the opening salvo in the foreclosure process. And I think that is just about it. And I don't know about all of you guys, but I had great fun. I always like these little seminars. And you all rocked. You answered all those questions really well. So you are great. And like I tell all my classes at the end, I am your biggest fan. So if you ever have any issues or problems, and we didn't discuss how to do this before, but anyone needs to contact me with questions, I am more than happy to, if it's a long question, put it in an email. If it's a short question, then put it in an email. And I would be more than happy to address issues and problems and questions. So I hope that was okay to say. We never really talked about it, but I figure why not? I should make myself available. So, and that is about all she wrote.
Well, thank you, Sam, for sharing some great information with us. And we will take time for questions now. Just as a reminder, please be sure to type your questions into the Q&A in your control panel. And we'll look and see if we've got any. We'll talk to you about how to get the recording, etc.
And I am wondering, how can is there a place for me to write my email address by any chance where everybody can see it, if it's allowed?
Donna, do you want to handle that?
Actually, Sam, what I think is just use the instructor at the CE Shop email, which is in the course, and then we can direct any of those questions to you that would be good for you to answer. Thank you.
That sounds great. Also, someone I saw somewhere, why would anyone get an ARM? Because the lender might be promoting it. For example, if they said, low introductory interest rate for our beautiful, wonderful Platinum Deluxe product, which is probably an ARM, 4% introductory rate, but their fixed rates might be at 5%. And if you get our adjustable rate mortgage today, and today only, we'll give you an owl. See, personally, I'm a sucker for the helium-filled balloons and the pens, but sometimes they upgrade to an owl. So in other words, they try to entice you to get the ARM. And if it's got a really competitive interest rate to start with, and the interest rates are stable, and the index is conservative and stable, then I've had ARMs before and I was treated very nicely by them. You just have to shop intelligently when you're looking for them. So anything else? Anything else? And thanks for everybody who is in the webinar. I really appreciated all of your time, and I appreciated your being here. Spread the word and tell everybody how wonderful the webinars are.
We actually, go ahead, Amy.
I was going to just say thank you. It looks like we've covered all of our questions. But go ahead, Donna.
We do actually have one more question that just popped up. Will end of course exam questions specifically related to Maryland, will it say it's a lien or intermediary state? Sorry.
Well, my experience has been from state to state. Your content for your state will tell you what your state is. So for example, some of the courses I've seen in North Carolina, they would say North Carolina is title theory and we use deeds of trust. Illinois content would say it's an intermediate theory state and what the ramifications of that would be. So you have to check. I'm putting the responsibility back on you, the student. You have to check your content to see what state you're in, not the state of confusion, some other state. So what state are you in? Is it title? Is it theory? And then you'll see what the ramifications of that are. So usually it's up to the student. What am I in Delaware? Am I in Maryland? Am I in Colorado? Or, where am I? So I hope that answered the question.
Can I jump in for a minute, Sam?
Pardon me?
This is Jill. May I jump in for a minute?
Of course, Jill. Be my guest.
Thank you. Cynthia, when it comes to Maryland, and you and I have had some communication about this, so I know what you're asking about. I am not sure whether our exam within the CE shop, and Donna might be more confident than I am in answering that, will address it, but you and I will work it out if it does. What I will say is this, that I have not seen, and this is just for anyone from Maryland here, don't anybody else listen to a word I'm saying. I have never, in the years I've been teaching in Maryland, and I have checked with 3 of the other instructors that I work with closely here, I have never seen Maryland ask that question. Maryland is, as you're aware, one of those intermediate states where deeds of trust and mortgages are both used, and the foreclosure process is quasi-judicial.
Very good.
Okay. Thank you. Here's another question. When would you use an amortization chart?
You would use an amortization chart if you're taking a test and they give you one. Then, of course, you're stuck. You have to use an amortization chart. But the alternative is, if you don't use an amortization chart, you literally either know the algebraic equation to do the calculation, and nobody knows that. Nobody wants to know that. Or you have a financial calculator, so you can figure it out. That payment question is called a 6 function of a dollar. It's one of the 6 functions of a dollar. In my appraisal classes, I teach all 6 functions, and we use an HP 12C to solve it. But then when you take the state exam for appraisal, they allow you in with the financial calculator. You are allowed in with a calculator for your exam, but you don't need anything fancy. You need a $5 Walgreens calculator. That's all you need. Therefore, if you're not using a fancy schmancy calculator, you need a table. And so that table, and here's a photocopy of the table that we had in that slide. That table is what you need to calculate the answer for 1 or 2 of their problems. In a real presentation, when you're in front of a client, never bring a big book of charts. It looks like you're from the Stone Age. So I would recommend learning at some point down the road when you're making money, get a little financial calculator and take a class on how to use it. That's all you need. So for right now, chart, $5 calculator, and you should rock this. There shouldn't be any issues about using this chart at all. So how are we doing?
Thank you. I was going to say, it looks like we've covered all of our questions. Sam, is there anything else you'd like to cover before we wrap up?
No, I think everyone did really well. Everyone seemed to be, I couldn't see any of you, but I'm assuming you were all there and you were all contributing. You were all answering questions. So I appreciate all the kind words, and that's really about it on my end. And I would love to have future webinars where we talk about the same topic or test taking tips or anything that all of you want. Just make a suggestion. And I'm sure we'll all just hunker around and try to figure out how to make these things happen. So thank you very much. I appreciate being here.
Well, great. Thank you, everyone. We appreciate you being here too. And I'd like to thank Sam for joining us today. Sam, your knowledge, expertise, and willingness to share it with our student community is greatly appreciated. And everyone, please look for an email from us with a link to this webinar recording, and keep an eye out for invites to additional webinars in the near future. At the conclusion of this webinar, you'll be invited to complete a survey. If you can take a minute, we love your feedback so we can continue to provide valuable webinars to you. Thanks again for joining us today, and we'll see you next time.
Thank you very much.